Hello, everyone. James O'Reilly here from Northeast Wealth, and I'm here today with David Bassanese for our summer economic update. David, as always, thank you so much for joining on.
Great to be with you.
Lots to get through. One of the obvious things, of course, is the looming interest rate decision from the RBA. I think there's enough speculation being done already as to whether or not that's going to happen or not. For the most part, people seem pretty confident that we're going to see a cut there. So, if I may, let's talk about what happens in either path. So, if we do see that cut that everyone's hoping for, practically, what does that mean for the economy and perhaps asset prices more broadly?
Well, I think certainly many in the economy, the economy at the moment is going through a slow patch. Employment growth is pretty strong, underpinned by, the care sector, NDIS, healthcare, but they're not really cyclical things. That's being driven by structural shifts in the economy. But consumer spending, the housing sector, really in the doldrums and kind of waiting on some interest rate relief. So if we do get that rate cut, I think we'll see a bit of animal spirits maybe returning to the consumer sector and maybe even to the business sector. And by contrast, if we don't get that rate relief, I think there's just ongoing despair and just waiting for some relief, because the cost of living pressures, that squeeze on incomes from that lift in inflation is still with us, as are higher interest rates. So there's really, they're just waiting on some relief. And I think it's warranted. As you said, many are now expecting it. Inflation's come down nicely. So I'd be surprised if the RBA didn't deliver. But yeah, we'll just have to wait and see.
It's interesting that you mentioned that. I think about the talking with our members and talking with prospects about their own financial circumstances, and it really does seem that there are a lot of households, even high income households, that are doing it tough, as we say. It seems that not only can it not come too soon, but if there is to be a rate cut, it's not the silver bullet like rate cuts of other times where we say, all right, well, thank goodness that's just a huge amount of relief and everything's going to be better from now on, because really rates have had to be incredibly high and they're set incredibly high right now. There's quite a few rate cuts that would practically need to happen to genuinely provide like proper relief to households.
Yeah, look, the way interest rates are at what we consider restrictive levels. The cash rate is at 4.35%. Like a long run neutral rate is probably 2.5, 3. So we're above that. So the RBA is kind of not putting its foot on the accelerator here. It's really just taking its foot off the brake a little bit.
Well said. Let's move across, if I may, to the global economy. I mean, one of the big things that's happened over the last quarter has been that we have had I won't say a new president because he's not new, but we've had we've had Trump back to the White House, and that's had an interesting effect on the economy more broadly. I mean, of course, he's outlined some very strict plans in terms of tariffs and what he intends to do that will have a global impact. When he was successfully voted in, then that seemed to have quite a strong run in the equities market over there. Some of that has tempered off. Like, how do you see Trump's term in terms of the US market? And perhaps what are your thoughts on the US market more broadly, please?
Yeah, look, I think the return, firstly, it was a rerun of Trump 1.0 when he first won markets. The presumption was if Donald Trump won last time around, markets would collapse because they thought, it was an unknown certainty. And actually markets rallied because
The other way.
they focused on the tax cuts, and it was a positive for the markets, really underpinned them through 2016 and his first couple of years of the administration. This time around, they tried to play the same playbook. Markets initially rallied, focusing on his promise of tax cuts. But this time around, he's not led with tax cuts. He's actually started with, immigration cuts and tariff increases, things that are really what economists term negative supply side shocks. They dampen activity, but also put upward pressure on prices. So the last thing you really want to see, and the tax cuts are something for the future. So unlike Trump 1.0, the policies this time around are not as market supportive, at least initially. Now, again, it remains to be seen what he will ultimately do. The other, I guess, variant to all of this is what he says and what he actually does aren't necessarily the same thing. So he's talked tough on tariffs, But we all know that, a big increase in tariffs, which is a tax on imports, would feed through to US inflation at a time when it is already still uncomfortably high. It's come down, but not as it's still higher than the Federal Reserve would like. So the last thing the market can really afford is an increase in inflation here on the back of tariffs, because it would mean the Fed won't be able to cut interest rates anymore. The Fed may need to even raise rates. And market valuations, particularly in the US at the moment, are pretty stretched. The US market is trading at a price to earnings ratio of 22 times earnings. It's a level we've only been higher than this in the dot-com bubble, the late 1990s. So the market would be vulnerable to a rebound in inflation and bond yields. And so we don't want to see that. But again, ultimately, I think what we'll see here is the bark will be worse than its bite. He will probably, temper the degree to which he does increase tariffs and even cut immigration, because, immigration, even illegal immigration in the US, is actually quite important to the economy. Something like 6% of the US labor force is estimated to be illegal immigrants working in many areas where, people, don't willingly want to work in these areas. So they're filling gaps in the market that would otherwise be difficult to fill. So we'll see how it plays out. But the markets at the moment are sort of, I think the sense is his bite will be worse than his bark. But the barks when they come are still a bit unnerving for markets.
Yeah, they are loud barks. Yes.
Very loud barks.
It's interesting you talk about the US market and such a high PE ratio, the price to earnings ratio. So much of that, as I understand, has really been driven over the last 18 to 24 months by the tech market, in particular, this tremendous run that some of the larger players, the Magnificent Seven, have had in the tech market. Just a couple of weeks ago, we saw Deepseek appear unexpectedly, and then as soon as it did,
Yeah.
was it 15% of Nvidia's share price was wiped out overnight, which I think speaks to the hype with which these valuations are coming in, and the anticipation that these companies are going to continue doing outrageous things unimpeded. How do you see that space right now, and how do you think about people who are looking, like, how do you consider investing in that space currently?
Yeah, look, I think two things happen. Obviously, they've had a great run over the past 18 months. Firstly, inflation came down, interest rates came down, the Fed started to cut rates. So that's a macro backdrop that is usually good for growth parts of the market, good for technology. So whereas they underperformed in 22 when interest rates went up, they've outperformed when interest rates started to come down. Over the top of which, as you point out, was ChatGPT in late 22. That stormed onto the markets, and everyone suddenly got very excited about artificial intelligence, and that really gave an extra boost to the tech sector in the US in particular, not just Nvidia, but Google, Facebook, all of these companies being seen to take advantage of the AI technologies, a new source of demand. Now, DeepSeek has come along, and the bottom line of DeepSeek is they've seemed to have created a way to do artificial intelligence searches much more cheaply and using much less power. And so the assumption that we needed very high price NVIDIA computer chips to run this, we need a lot of power to generate this, is being rethought. And so that, I guess, that extra tailwind for the tech sector from AI is it, in the moment being questioned. And look, I think generally for the tech sector, it's good news. I mean, if use of artificial intelligence will be a lot cheaper, it means more people will be able to use it. There'll be wider applications. And so it's good, I think, for consumers of AI and people that are going to be generating AI applications, not so much for the initial maybe technology providers such as NVIDIA, for example. So we saw a little bit this in the dot-com bubble, the late 1990s. Some of the early pioneers in the tech boom, providing networking, hardware equipment, they had a great run, and then everything became cheaper and easier to use, and it ended up being the consumers of tech that did well, like the websites themselves and the Amazons and the Googles and the Facebooks and whatnot. So we're in a state of flux at the moment. I think that the overall macro backdrop is still good for the tech sector, but I think there may be a shake-up in terms of the winners and losers that are going to start to play out.
Yeah, well said. Can I ask, when we think about valuations more broadly, over the last, let's say, 24 months, most asset prices have performed for the most part really well. And it certainly does leave our investors and also advisors thinking a lot harder about where do we get good returns from moving forward in an environment where everything is well priced. Where do we get it? And you had an interesting view around what's well priced at the moment, right? Can you share that?
Yeah, so if you look at the overall global market, it is trading. I think the global market is trading at like 18 times forward earnings. It's the top end of its range of the past few decades. But if you split that out, the US market's trading at 22 times earnings, and the US market is about 60 to 70% of the global market now. So it's a huge chunk of that. But the remaining 40 to 50% is non-US, and that's trading at around about 13 and a half times earnings. So, and which is in line with its long run average. So, it's really the US in particular that is boosting overall valuation. So there are pockets of value, around the world: Europe, Japan, China. Emerging markets more broadly. Funnily enough, our market not so much. So we're trading at a rich valuation, courtesy of our banks. They're trading at pretty high valuations at the moment. But I think in Australia, earnings, we're anticipating an earnings rebound, which is starting to come through. So I think part of the earnings, the valuation premium in Australia is that expectation of earnings rebounding, which I think is coming through. But just, yeah, at the moment, there is value elsewhere in the market. But the problem has been that it's one thing to have cheap looking stocks. There's another thing to find a catalyst for those to start to outperform. And many people have been buying non-US areas of the market for several years thinking they're cheap, but they just haven't moved. So we're just waiting to see whether or not that will happen. Now, AI, funnily enough, could be the catalyst for that. The Deepseek transformation that we've mentioned. If some of the valuations in some of those large cap stocks start to shake out, we may start to see a broadening of the rally to other areas. And I guess the other thing, corporate earnings outside of the tech sector is picking up. So we're seeing a narrowing of the divergence of earnings performance, if you like, between large cap tech and the rest of the markets. And as you get that convergence in earnings, I think we could start to see some catch up in these cheaper parts. So, as I speak, Europe so far this year has been outperforming. So there's one value part of the market. A lot of bad news in Europe, but it looks cheap. The central bank there is cutting interest rates. It could be one area that is starting to turn.
And I'd love to lastly get your views, if I may, on Australia's banking sector and just the strength that we've had there. I mean, CBA share pricing $162 or thereabouts, and I've watched this. Using our own external research, we watch most every company is willing to give a valuation is saying it's overpriced and it goes up. It's even more overpriced and it goes. It's even more overpriced and it just continues on its way. Like, what's your view, for example, like not just on the CBA share price, for example, but just more broadly, Australian banks, are they priced correctly?
Look, they do look expensive. It's hard to really justify the valuations where they are, given the relatively muted earnings outlook for the banks. I mean, the banks are going to generate earnings, but we're talking single-digit earnings growth. The big, well-established companies. So for CBA to trade on a growth premium for a slower growing value stock doesn't make a lot of sense. I think we can. The catalyst for that, I think, have been manifold. I mean, so why has this happened? Firstly, global financials have been doing well, and that's because of the value and the turnaround, the profits there. So that's helped drag up our financial sector, just the outperformance of global financials. Secondly, I think the earnings story of the banks relative to the rest of the market has been good. There's been upgrades to the earnings outlook for the banking sector over the past year, and that's because essentially a lot of the bad debt concerns around the interest rate, go back a year or so ago, we're talking about the mortgage cliff and worries about many households not being able to pay their mortgage as rates went up. Now, it turned out that wasn't as bad as feared. And so a lot of the bad debt provisions the banks made, they were able to reduce. And so that's been an uplift to their earnings. Last but not least, one thing we've noticed is there's been some buying. We suspect part of the rally in the banks have been a lot of the large super funds, particularly the industry super funds, are now having to invest closer to benchmark, the market benchmark. The regulators are insisting there's big penalties if you deviate from the benchmark for too long. And one of their biggest deviations from benchmark is being underweight banks. And so we've seen a lot of buying from large super funds over the past year to narrow their gap, at least to the rest of the market. So these are, so that's probably a process that may be playing out for a bit longer. But yeah, it's hard to definitely justify the high valuation. But at the moment, again, the catalyst is there. And again, if the RBA does start to cut rates and we see credit growth pick up and home lending pick up, it may well continue to support the banks at the moment.
Well, David Bassanese, thank you so much for your time today. I'm very grateful, and it's always an absolute pleasure to hear you speak and get your insights, as I know all of our members really appreciate. So, mate, thank you for your time. And to all of our members, of course, these are things that we'll be talking to you about in the not too distant future as we do your portfolio reviews. Mate,
Thanks
thanks
very
very
much,
much.
James. Okay.
Chat to you soon. Bye.